We got another weekly market review where we analyze the stock market to see if a correction or crash is coming. Protecting your downside is the most important thing you can do for long-term success in the stock market, and that's exactly what we do here at Fallible. So first off, we're going to go over some inflation statistics to keep track of that because, that's a huge topic right now. And then we're going to move into the stock market to see what's going on now. Are stocks going to rebound? Will prices recover? And then we also just added a new stock to the macro ops portfolio that you're going to want to add to your watch list at least. And finally, I got an update on the Fallible portfolio for you as well, so stay tuned for that. As with all of our market reviews, we're going to use our research from Macro Ops, our global macro research and consulting firm. So let's kick it off talking about inflation, and we got some new research from Credit Suisse here. And they're saying that there's a good case for increasing and enduring inflationary pressures. So they say CPI expectations and oil prices are closely correlated. Commodities are in total, directly and indirectly, 7% of the CPI, and they're in a bull market right now. So much of the shock from the price discovery process of disruptive technology has been seen. So as oil prices and commodities continue to rise in price, we are going to see that inflation as well. And if you watched our other videos, you know we're in for a huge commodity bull market soon. And while this is happening, other deflationary pressures are actually reversing. And I know this is a big topic because every time we talk about inflation, there are people in the comments saying, no, we are facing deflation. Especially with all our technological innovations, prices are going to keep coming down. We are never going to get inflation again. Well, that's not what Credit Suisse thinks. So another factor that they bring up is that Chinese labor costs are no longer cheap. So that's reversing a tailwind for companies offshoring their production. Globalization had previously taken off 1% of CPI each year, and trade has lowered prices of household goods by a quarter to 2/3, which has been a huge effect. But if that's all going away, then we are going to see way more inflation. Along with that, Bank of America has new data showing how food prices globally are rocketing higher. There's also been a slight turn up in union membership. So you can see right here, food prices shooting up. We've covered that in previous videos as well. And unions are becoming a thing again. And that's another topic we've covered a lot too, the whole wealth disparity problem. That can only go on for so long until it reverses because people are angry. And you can see right here, war on inequality trend has begun. Union membership is just one data point pointing towards that. Moving on, we have gold. And if you remember in previous videos, we've talked about how there has been incredibly weak breadth in gold miners. So fewer than 15% were trading above their 200-day moving average. And remember, we use breadth to gauge a market, right? If you have a strong, healthy market, then all the stocks kind of move together. You don't want just a few propping up the entire thing. So the reverse is true here too. If every stock is below its 200-day moving average and trading really low, that might be a sign of a bottom, which is exactly what we're saying right here. This type of action typically precedes bottoms. Now that that's happened, sentiment and positioning have now reset. Real yields are starting to stabilize. The conditions are now setting up for the next leg up in precious metals. So for everyone who's been asking me about gold and silver, here you go. Looks like prices will be turning around from here. But we're probably still a few weeks out from that happening exactly. We're looking for at least one more dip. We want to see the gold ETF holdings stabilize, if not turn up, which they haven't quite done yet, but we are close here. Another market we should be looking at is the US dollar. And what we're watching for now is a continuation of the secular bearish trend. Looks like sentiment and positioning have fully reset and are no longer headwinds. And a falling US dollar can have long-tailed pass-throughs on inflation. And the reason why is because if we're in a global economy, a weaker dollar is going to make everything way more expensive for people in the US. And if prices are going up because of that, then what is it? It's inflation. Bank of America thinks markets have overdone themselves. We're now in for the 3 Ps of peak positioning, profits, and policy in the first half, and then the 3 Rs of rising rates, regulation, and redistribution. This is not great for the stock market, and this redistribution part is going to be rough too. More taxes. Now let's move on to the stock market directly and see what's going on over there. The narrative pendulum has swung to the other side over the last 6 months, and this right here is the San Francisco Fed's new sentiment index. So you can see when the pandemic was happening, and of course it's still happening, but at the height of it, there were tons and tons of bearish stories. And that's what you can see right here with this red. That's what it's tracking. It tracks all the news stories actually as it tracks the market itself. So you can see here extreme bearishness and the market rebounded hard. But this bearishness has been going away. And now people are becoming bullish. We haven't seen it turn green yet, but it's very well on its way. Meaning things have really swung over to the other side now. People are super bullish. But what do we know about sentiment? If people are too bullish, it's actually a bad thing. You want people super bearish because that means there's money on the sidelines left to come into the market. But if everyone's bullish and already has all their money in, then what is going to push prices higher? So that is definitely something to watch out for over here. But on a positive note, the Nasdaq's short-term breadth held and rebounded off critical levels last week. Here's the breadth indicator right here. You can see that it rebounded and is heading higher again. And the Nasdaq now looks coiled for another run higher, and we're likely entering an accelerated buy climax. So as you can see right here in the Nasdaq, we're getting a pretty pretty tight pattern. A little triangle here that we think will break higher to the upside. And this is being helped by the fact that rates are recovering a bit. Well, the last few days they've been going down again, but it looks like they may have put in a bottom. We still have to see. So nothing is for sure here, especially when it looks like the NASDAQ is down another percent today, but it's pretty much staying within a range. You can see these wicks here, they dropped low, but the market recovered. So there seems to be a support right around this line. Now, bullish sentiment remains stretched like it has been for a while. See, we're still at 7.2, but it's likely this coming bull move that we're about to get will get the market over its skis and give us an official sell signal, because this is the Bank of America bull and bear indicator, right? It's another sentiment indicator. And once again, like I said before, you don't want people extremely bullish because that's actually a bearish sign for the market, which is why if they are extremely bullish, you can see they have a sell signal right here. If we look at the S&P 500 on a monthly chart, you can see that the market is set to close above its upper trend line right here. And if it's doing that, then it's likely that the market is entering a buy climax. So the path of least resistance is up. On a weekly time frame, we could see that the market is churning through the $4,000 significant level. So as long as rates don't accelerate again to the upside, meaning bond prices don't drop like crazy again, then equities should soon break to new highs. And remember, a buy climax is when we get a massive blow off bull run and then we see the crash. Now, you don't want to get out before the buy climax because there is a lot of profit to be made, but the important thing is to manage your risk on the way up because you don't know when it's going to turn around. And when it does turn around, it turns around fast. And then comes the crash that everyone is waiting for. Now here is a 120-year annotated chart of the Dow Jones. It's interesting to see the recovery times for new highs after periods of sideways movement or crashes. And it's funny because people don't think that the market could do something like this, like it did in the 70s, where it just goes sideways for 16 years, not making new highs. This is the problem with passive investing. You can start during a few decades where the thing goes straight up, but there are also times where it goes sideways. So if you started in the 60s and 70s, what would you do? Or here, this massive crash, it was a 25-year recovery time. So this becomes a problem if you are buy and hold because you don't know what market regime you're actually in. You could get lucky, you could get unlucky, which is why I personally prefer, hey, I'm going to use a system that is going to manage my positions, that is going to catch upswings and minimize downswings so that I can make money in, any type of market. But if you're watching this channel, you're obviously already a more active trader, so this probably doesn't apply to you. But this just gives you a nice little reminder about why buy and hold may not work that well. Now, a stock we scooped up was Discovery, ticker symbol DISCA. It took a massive dip recently. You can see here it dropped almost 50% in just a few days. It was the largest weekly drop in the stock's history. Now, this is a stock that we've covered before, and we think it's fundamentally pretty solid. So this seemed like a buying opportunity, at least in the macro ops portfolio. But of course, this is knife catching, so be careful. Alex bought it in the macro ops portfolio, but me personally, if I was still discretionarily trading, I would wait for a base. I would want that base to form before I got in because it's a lot lower risk. But the idea with catching a falling knife is that you catch it at the right moment just before the huge rebound where you make a lot of returns. So I guess it depends on how you want to play it. I'm just more risk averse than that. Now, a quick update on our Fallible investment system. So you know how it works. It's a momentum system where we have this algorithm right here, our TSI, which is our momentum scanner. What it does is scan the NASDAQ and it finds the stocks with the highest momentum, and it just spits out this number right here. And what we do with our system is that we rotate into the top 5 highest momentum stocks every month. And we do that every first of the month, which is coming up pretty soon, right? A few days. Now it's looking like, according to the information that we just went over, we may get lucky here. The market has been beaten up a bit and we may be getting in just as it's ready to take off if this buy climax is happening. But we may also get unlucky. We might buy in and get knocked out right away because the market decides to take a dip lower with rates rising. Obviously, I don't know what's going to happen because I can't predict the stock market like that. We can only play the probabilities and manage our risks so that we are long-term successful, which we have been very successful with this system. It does 4 times better than the stock market. Now, if we do come to this new rotation and we get knocked out right away, it's going to suck, of course, but I'm not really worried about it because I'm focused on the long term. I know how the system works. I know we have our edge, and I know stuff like this happens. Markets go through periods when you're not making money depending on your system. No system makes money every single day. There are always going to be drawdowns. But it's funny because even though I explain this in many videos, we go through a lot of training for anyone who's using the system, a lot of people will still use it for a week, and in that week the stock market might not even go down. It might just go sideways. And nothing happens to the stocks held in our Fallible strategy, but at the same time, these people still say, hey, this thing is broken. It's not working right. And it's just funny because, I explain the idea of long-term cycles and how the system works. You can see past returns, all of that. But there's nothing that you can really do if people just aren't open to working within the limits of the stock market. Because I've been teaching this stuff for so long that I know if someone doesn't want to hear what I'm saying, then they're just not going to hear it. It doesn't matter. If they are only looking for some magic solution for returns every single day, well, I'm sorry, but you're not going to find that in the stock market. That's not how the stock market works. And it's not necessarily their fault either. The stock market is not easy, and a big reason why is because of this. Because it's random, because it dips so hard, because you got to have that emotional control and that risk management. So it really isn't easy. So we've talked about this a lot on this channel about financial technology, Fintech. It's been all the rage, right? Democratizing finance, making sure everyone has access and everyone can manage their own investments. Gamifying money, like Robinhood with the confetti every time you make a trade. Now, on one side of the coin, yes, it's good that everyone should have access, but on the other side, not everyone should be managing their own money. In fact, I would say 90% of people, even 99% of people shouldn't be touching their own money. Now, if you have the tools and you can go in and learn with a small amount of money in the market, that's one thing. And the best outcome is, you try that, you could see how it goes, and then you could see if it's for you or not. And for most people, it's not going to be for them, and that's okay. That's why at that point, they could go find someone to manage their money. But then they run into the problem that a lot of financial advisors are actually terrible. And it gets complicated because the good ones can't even speak out and promote themselves because there is so much SEC regulation coming down the pipeline each year. Basically, what the SEC wants is for no one to be able to sue each other. They don't want lawsuits. That's why they put these regulations in place. And you know what the best way to make sure that no one can sue another person for bad financial advice? Make it so that people can only make their own financial decisions. They can't go to anyone for help, which yes, that reduces the number of lawsuits, but it also leaves a bunch of people screwed because they don't know what they're doing. It's like, do you really want everyone managing their own investments? It's the same thing as asking, do you want everyone performing surgery on themselves because you don't want doctors getting sued? No, of course not. That's why over the years, we've just become more and more selective about who we even work with and talk to. It's like, I only want to be talking to people that are serious about markets and have their expectations in check. You can make amazing returns, absolutely, but you got to understand how the market works and that there are going to be drawdowns even in the best strategy. So this is just something I've been thinking about because, again, we don't know what's going to happen to the market in a few days. We'll never know. But this is how it always has been and how it will continue to be. You're never going to be able to predict the stock market. It's going to go up. It's going to go down. The only thing we're going to do the whole time is manage our risk. And over the long term, yeah, we're going to get great returns like we have been. According to our research, it does look like the market is going to rebound hard here, but again, who knows? But if you want to learn exactly how we're going to take advantage of it, then make sure you check out our free training right here. It teaches you the exact strategy that I myself use and all our Fallible members use as well. I'm going to put a link to this training in this video and down below in the description and comments. But again, only check it out if you are actually serious. It's an incredible strategy and system, but it's not some holy grail magical market predictor. There's no such thing. I'm sorry. But if you want to see real investing, then click this link right here and I'll take you to that training. You're definitely going to want to check it out as we go forward in these markets. So click this link right here and I will see you in that training.